The real estate bubble is going to pop, but not when and why you might think. It's different this time. Very different. Let's take a look. Hi, my name is Matt Theriault, CEO of Epic Real Estate, where we show people how to invest in real estate so they can escape the daily grind and retire early. And right now, we are in an unprecedented real estate bubble. It's a big one, but it's one with a strong, for now, impenetrable surface. So for those that are predicting 2021 to be a replay of 2007, those that are waiting for the proverbial blood in the streets before you jump into the market, you're gonna be waiting for a while. You know, I've been saying this here for months. Too much confrontation. No reason to get angry with me. It's just data, statistics, and math mixed with a little opinion, I guess, but almost exclusively data. I'm not alone, though, in my analysis. This week, Nicole Friedman of the Wall Street Journal wrote an article. The pandemic ignited a housing boom, but it's different from the last one. Perhaps she's been watching. Maybe she's a subscriber. So here's how this real estate bubble is different than the last. There are 6 unique things that are happening right now. Number 1, buyers have more cash and higher credit scores. For example, it's not uncommon in a market like Boston right now for buyers to come in with a $500,000 down payment for a $1 million purchase. The rich have gotten richer. The rally in stocks boosted the U.S. household's net worth by $7.6 trillion, according to the Fed. The second quarter of 2020 alone was the biggest quarterly gain to the U.S. household's net worth since 1952. Number 2, previously owned home sales surged to their highest level in 14 years during 2020, to a point where it has caused a supply crisis, meaning we're seriously short on supply. Last crash, the exact opposite. We had too many houses for sale. Housing inventory has never ever been as low as it is right now. And many economists are forecasting sales to keep rising, devouring the leftovers. Number 3, lending policy. Pre-2007 market crash, we had very loose lending guidelines. I mean, if you could fog a mirror, you could buy a house, a much nicer house than could be afforded even. Mortgage programs made this possible, giving new home buyers super low payments in the early years of the loan. But those low payments weren't permanent. They adjusted. Financial firms packaged these risky adjustable mortgages as securities and sold them to investors. When those adjusted mortgage payments kicked in, homeowners started to default, and we were flooded by a foreclosure tsunami. According to the National Association of Realtors, between 2006 and 2014, approximately 9.3 million households either gave up their homes to foreclosure or sold under distressed conditions, to where the lenders suffered enormous losses, causing the entire financial system to freeze up. Lending guidelines since the 2007 crash have been very tight because of this, and today are still very tight. And because of this, banks and investors are sitting on the best paper they've ever had on their books. It's the low interest rates driving the demand this time, as opposed to the easy access to credit last time. Financial firms are still packaging mortgages as securities, but the vast majority of those mortgages today have government backing. Don't count on shenanigans on the secondary market to bring the market down this time. 4, new construction. Now, during the last housing market crash, the market was overbuilt. There was massive new construction that led to a significant oversupply of houses. The market had no option but to crash. That's what happens when supply is strong and the demand gets devastated. Buyers right now are gobbling up previously owned homes as quick as they come on the market. And builders can't build new ones fast enough to feed that demand. And there are now growing hints of their lack of desire to even try. You see, builder confidence has been on a steady slide downward since November due to rising costs of building materials. According to the National Association of Home Builders, in an article posted March 16th on Fox Business, new home contracts are being canceled because of it. The concern here is that builders will have to pass on their rising costs to buyers in order to produce a profit and maintain steady production. There are doubts that the demand will be there to support the costs when that new construction hits the market. Now, currently, the demand is so high that many builders are limiting the number of homes they sell to ensure that they don't sell more than they can build. Oversupply, that's not going to bring the market down this time. Number 5, demand. Now, there's little argument from real estate analysts that the pandemic helped ignite the current housing boom as city dwellers left major metropolitans for cheaper cities or for more space in the suburbs while working from home. When quarantine restrictions began to loosen in June, home sales surged 21% over the previous month, and then again by almost 25% more in July, making these the 2 biggest monthly increases on record since 1968. And these 2 biggest sales months since then fell in back-to-back months, something we've never seen. Between the mass urban exodus, record low interest rates, and millennials maturing into their home buying years, we're amidst a perfect storm of demand. And this storm won't be blowing over anytime soon. Number 6, foreclosures. That's everybody's trump card for a housing crash, right? Like, what about all the people that aren't paying their mortgage? That's certainly got to bring the market to a screeching halt when the forbearance programs end, you'd think. The shares of mortgages in forbearance continue to decline, down to 5.14% in February. And this number will maintain its downward trend as the economy opens up and people return back to work. Those mortgagors remaining that still can't afford their payments will almost assuredly be able to sell their homes for a profit rather than face foreclosure. Then what's left of the homes that do ultimately go to foreclosure are going to be gobbled up by drooling homeowners and investors. They're there, they're waiting. So don't count on foreclosures to bring this market down either. It's not like last time. So what will crash the market? Well, now that we're on our way out of the COVID-19 pandemic, there are still a number of longer-term trends at play that should continue to actually support the hot housing market. Most notably, millennials are entering their prime home buying years and will be in their prime for the next decade. That demand, it's undeniable and it's inarguable. We've witnessed the baby boomers impact the housing market in the same way, and the millennials are an even bigger generation. We've seen this movie before, and we know how it ends, and it's gonna have a bigger ending. Not to mention, as the baby boomers begin to pass, there will be a transfer of wealth to the millennial generation like none we've ever seen. That transference of wealth translates to millennial buying power. Unless more supply hits the market, much more supply, we could be watching a rising housing market for a very long time to come. Now, the biggest winners so far in today's boom are people who already own homes, who gained a collective $1.5 trillion in equity in 2020 from a year earlier. They have also saved money by refinancing their mortgages at record low rates, and many of them have been able to leverage their refis into investment and vacation homes. Now, real estate brokers, home builders, and mortgage lenders are also riding this wave. The S&P Home Builders Select Industry Index is up 96% over the past year, outpacing the S&P 500's 59% gain. Real estate works. And it's here at Epic we know that most people are living a life of financial sacrifice and betrayal. So we've built a system that creates an opportunity for one's money to work harder for them than they did for it, saving them and their families from a lifetime of financial worry. And it all begins with income-producing real estate. So with market conditions like these, what is one to do? Where does one begin or maybe resume? Well, there is some hope if you're looking to get into real estate without paying through the nose. As is usually the case with real estate, these trends, they look different according to location. You've heard the expression, location, location, location. Many of the areas that still have a strong housing inventory are places that have seen increased home construction to accommodate the growing population. So if you'd like to get in on the action, whether that be with an investment property or a new home, at the state level, Florida is the clear leader in the number of homes for sale, with 248 active listings per 10,000 homes, and Hawaii, 229 per 10,000, and Georgia, 210 per 10,000. Not far behind, Nevada and Wyoming also pose a decent amount of housing market opportunity. It's in these 5 states where supply and demand are currently keeping pace with one another more than they are elsewhere. This makes these states more favorable for home buyers and investors because while there are more competitors in the market, there are also more options available. So the bottom line for all of the housing market crash predictors, the current housing boom is far more stable than the previous and poses fewer systemic risks. This time, it's different. But that's not to say it's entirely without risks. So let me know, I'm curious. What did I miss that could crash the market? Let me know your thoughts below. And who else do you know that needs to see this? You know, when their name comes to mind, please share it with them. Oh, and if you're already subscribed, I pulled this video out special for you to watch next. Otherwise, I'll see you next time. Thanks for watching. Take care.